Welcome to Retirement Ramblings. I'm Scott, and today is day 297 on my countdown to retirement. And it was a brutal day in the market today. I'm now underwater, having watched 4% of my portfolio value evaporate in the last 30 days. That said, we all know that a 10% pullback in the market is not uncommon. And should we end up going into recession, you could see pullbacks, north of 30%. So that's a pretty scary, thought, especially for those of us that are, on the doorstep of retirement, because sequence of return risk is a real thing. That being said, I put together my shopping list. So I have orders that I placed, for the likes of VOO, VLK, IUSV, MPC, EOG, TJX, Google, Amazon, IAI, and Bug, which is a cybersecurity ETF. And all of those orders are basically placed at a level that was below the low prior to Trump winning election. So it would have been a complete round trip on all of those, and then some, from before the election, to where I thought a more reasonable valuation was on those particular stocks. One of the, I just want to talk about Bolden or New Retirement for a moment, because one of the weaknesses of a software program, at least like Bolden, is it doesn't allow you to put in negative returns or to vary your returns year over year. It uses, an average that you put in for pessimistic or optimistic, and then it calculates the average between the two of those to give you kind of your average return between those two items. So you can't model for sequence of return risk. You can't model for a lost decade. You can't sit there and say, well, I think I'm going to be in a 30-year retirement window, and this is the return I expect to get each year, some up, some down. It doesn't work like that. And, again, when you're trying to model out your retirement, over the long haul, the averages work. But if you're trying to model out what happens if you have a bad year in the first 5 years of your retirement and your portfolio goes down 30%, like, you can't do that. So really the only way to handle sequence of return risk, if you're using a program like Bolden, is you got to have a bunch of cash sitting on the sidelines, making the assumption that the cash will outlast any of the downturns. So as long as that's true, you should be okay. But that's effectively how you handle the sequence of return risk. So I'm just curious, with the market pulling back, and it's the first really substantial pullback I think we've had in, I don't know, I'm going to say 3 years, something like that. I mean, we've had a pullback before of like up to 8%, but it was very short-lived and then it bounced. But for a sustained pullback, we haven't had that in quite a while. So I'm just curious, are you buying? Are you selling? Are you sitting pat? If you're selling, are you moving to cash? Are you moving into some kind of cash equivalents? Are you moving into bonds? If you would, let me know in the comment section down below. I'm really curious to find out what other people are doing. In my case, as I indicated, like, I wouldn't say I'm backing up the truck, but I am looking to do buys because I did set aside, enough cash that I could probably go 3 years in a downturn without having to sell anything that I own. And I fully expect that whether it's this year or at the end of the Trump presidency, or even after the midterms, if things don't do well and we ended up with a divided Congress at the midterm point, I do expect that whatever happens for the long term, the market will go up again back above where it was, at the traditional highs. So long as I can outlast that, if I get any of these items at these lower price points, it's effectively getting them on sale. So I'm okay with that. It's very painful to look at the balances though on a day over day or week over week or even month over month basis, in the current environment. So if you had started to, looking at your balances, let's say last October before the election, and then you said, okay, now Trump wins on November 5th, and then all of a sudden you watch the market like just ratchet all the way up into February, or at least up through Inauguration Day in late January, and then you look at it now, basically, unless you have um, a portfolio allocation that's, pretty unique, you will have round tripped whatever you made over that, 3 month period. So again, I'm just curious to hear what you guys have to say on the topic. And also, if you're close to retirement or you're in retirement, how you handle sequence of return risks and, and what comes along with that. So if you would, again, leave me some comments down below or drop me an email at myretirementramblings@gmail.com. But anyway, I hope you have a great evening. I look forward to talking with you tomorrow. Take care.